Welcome back to Investing Talk Podcast.
Today we're looking at stock.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
All right, let's get into the analysis on stock. So this company, it's really positioned right in the middle of this whole AI infrastructure explosion.
Yeah, you hear that term a lot, but what's their specific angle?
Well, they're not just part of it. They're a core enabler. They specialize in really high-performance cloud stuff, specifically for AI, machine learning, visual effects rendering, even massive batch processing. Think really demanding jobs.
Okay, so it's not just like generic cloud storage. It's tailored, specialized speed, basically.
Exactly, specialized speed. And what really jumped out at me from the analyst reports you sent was how much they stressed this difference.
Yeah.
Analysts are saying their market position, their brand strength, it's like a real moat. It builds customer stickiness.
Because switching that kind of customized setup would be a massive pain. Yeah.
A huge operational headache, precisely. So they're not really going head-to-head with the big general-purpose cloud giants everyone knows.
They found their niche.
Yeah, they're selling infrastructure that's optimized, like right down to the metal, for these super demanding AI training models.
Yeah.
And that specialization, well, that's why we're seeing these frankly, kind of staggering numbers in their projections.
Okay, yeah, we have to talk about the numbers because honestly, they sound almost too good to be true. Like the venture capital talk. The revenue surge is projected to jump from, $1.92 billion in 2024 to $5.39 billion in 2025. That's 181.6% growth year over year.
It's massive. Yeah. Absolutely massive. And if you look ahead, what the market's expecting next, that really slows down.
Really?
Forecasts are hitting like $12.46 billion in 2026. So the key thing here for you, the listener, is that Wall Street, they're pricing in continued triple-digit growth annually for the next few years at least.
So it's not just a one-off bump.
No, they see this as a multi-year, multi-billion-dollar trend. And it's all powered by this huge demand for AI training compute.
Okay, and that belief, you can really see it reflected in the valuation right now.
You can.
Market cap's sitting around $51.8 billion. That was as of November 9th, 2025. So the market's clearly buying into this story already.
For sure.
But, that leads to the inevitable question with these high-growth tech plays.
Yep. Profitability.
Exactly. When does all this amazing revenue actually turn into, profit, cash in the bank?
Right. And that's where this idea of operating leverage becomes just crucial.
Explain that a bit.
Okay, so when companies build out this kind of massive infrastructure, buying servers, setting up data centers, the initial fixed costs are just enormous.
Bleeding cash initially?
Totally. But once that expensive stuff is in place, the cost to bring on each new customer, especially these big AI firms signing multi-year deals, it's relatively small.
Ah, I see. So the cost per customer drops dramatically as they scale.
That's exactly it. That's operating leverage kicking in. You move from those fixed costs dominating everything to a point where each big new contract adds a lot to the bottom line, marginally speaking.
Okay, makes sense. So how quickly do the analysts think that pivot, that shift, will show up in the earnings?
Pretty dramatically, actually. If you look at the earnings per share, the EPS forecasts, they expect it to improve really quickly.
Like how quickly?
Well, they went from losing $4.30 a share in 2024, narrowing pretty sharply, to a loss of $1.64 in 2025.
Okay, still a loss, but much smaller.
Much smaller. And then down to just losing $1.33 per share in 2026. That steep drop in losses, it shows that the infrastructure is getting way more efficient as they scale up.
So wait, 2026 is basically the break-even point then, on an EPS basis anyway.
Essentially, yeah. That seems to be the key aha moment analysts are pointing to.
And then profit.
And then the consensus view is that 2027, that's the year they hit real sustained profitability.
Yeah.
Analysts are looking for FY 2027 EPS to come in around $2.19 per share. So that aggressive narrowing of losses, moving into the black, that's what's driving a lot of the institutional conviction you see right now.
And that conviction, it's definitely showing up in the ratings. 22 analysts covering it, and they collectively rate stock a buy. The consensus 12-month price target, it's forecasting a pretty healthy 20 to 25% upside from where it is now.
So roughly $128 to $130 target range.
Yeah, exactly. That's a pretty strong signal from the pros.
Institutional conviction looks strong, yeah. But what about the chart? Does the technical picture actually back that up?
Good question. Let's look at the technicals.
So right now, the stock's trading around, what, $105.65?
Yeah, around there.
But we really have to stress the volatility here. This is not a sleepy stock.
No kidding.
It ran up like crazy from its 52-week low. I think it was like $33.52.
Yeah, low 30s.
All the way up to an all-time high of $187.
Right.
Just massive swings.
Okay, when you see that kind of volatility, like a nearly 500% swing in a year, what does that tell you about who's actually holding the stock right now? What kind of investor?
Well, it tells you the investor base is really dynamic, probably dominated by momentum traders, and folks willing to make big directional bets on this whole AI trend.
So maybe not for the faint of heart.
Definitely not. If you, the listener, are looking for something stable with low volatility, this probably isn't it right now. But if you're hunting for that explosive growth potential, well, that history shows you the kind of reward that could be there.
Looking more recently, though, the last few months, the trend seems pretty clearly bullish, right? Higher highs, higher lows.
Yep, that pattern's there. And participation seems strong, too. Look at the volume currently around 24.98 million shares changing hands.
Which is well above the average. Average is like 19.33 million.
Right. So high volume like that, it tends to confirm there's real interest, real conviction at these current price levels.
Over the last, say, 3 months, it feels like it's been trading in a range, though. A bullish range, but still a range.
Yeah, pretty much between $95 on the low end and maybe $125 on the high end. It's been quite contained within that, but definitely pushing upwards.
And that shows pretty solid support building up above that $100 mark, doesn't it? That's a key psychological level.
Absolutely. Support seems strong over $100. And then you see resistance kicking in near that $120 and $125 zone. We saw that fight play out not too long ago.
Yeah, that was driven by actual news, wasn't it, back in September?
Right. There was that big price surge in September. Reports came out about those large-scale AI infrastructure contracts they landed.
That validation of their specialized approach?
Exactly. But then October, we saw that sharp pullback. A correction, really. Lots of chatter about that.
But even after pulling back, the stock was still up, what, 160% for the year?
Impressive 160% year-to-date, yeah. Which tells you, I think, that the underlying long-term momentum, that secular trend, it's still incredibly strong, regardless of some short-term profit-taking.
Okay, so let's pivot then. What about the near term? What are the catalysts, the events coming up that investors need to watch? Because it sounds like the next few months could be pretty active.
Oh, absolutely. The immediate future is packed with potential triggers for volatility, things you really need to have on your radar starting today.
Yeah, what's happening today?
The absolute top priority event is happening right now. The Q3 earnings conference call, November 10th, 2025. This is really the moment of truth.
Okay, and what are investors listening for on that call?
They're going to be laser focused on, I'd say, 3 main things. 1, how fast is revenue ramping up from those new AI partnerships? 2, what are the gross margins looking like? Are they improving? And 3, probably most critical, forward guidance.
What are they projecting for the future?
Exactly. If they reaffirm their previous guidance, or even better, if they raise guidance for fiscal 2026, well, we could see a pretty strong positive move in the stock.
Makes sense. What about other factors like big money moving around, institutional flows?
Good point. We're expecting some institutional ETF rebalancing later this month, in late November.
That's pretty standard, right?
Yeah, it's common. But it can create some temporary volatility, maybe some volume surges, as these big funds adjust their holdings for year-end.
Okay.
Then, looking a bit further out into January 2026, the focus might shift to major institutional buy announcements.
Like a big fund disclosing a new position.
Precisely. If a large, well-respected fund comes out and says, hey, we just bought a major stake, that acts as powerful validation. It reinforces the idea that stock is a top-tier AI cloud growth play.
And the earnings cycle continues after today, too.
Oh, yeah. We've got the Q4 and the full year 2025 earnings call coming up. Plus, crucially, the initial guidance for fiscal year 2026. That's scheduled for February 2026.
So that'll be the next big data point after everyone digests today's Q3 news.
Exactly. Gives a fuller picture.
Okay, so those are the official things. What about the unofficial stuff? The rumors, the market chatter that always seems to drive short-term trading, anything juicy floating around?
Well, there's always something. We're hearing a few persistent rumors that, if they turned out to be true, could inject a lot of excitement.
Like what?
There's ongoing speculation about a potential mega-tech partnership, like an announcement with one of the really big generative AI firms, the ones that need absolutely massive computing power.
That would certainly confirm that specialized moat idea.
It really would. Then there's also market chatter about international expansion plans. Talk about maybe moving into major new markets like Europe or Asia. That could open up big new revenue streams pretty quickly.
And the rumor that always gets hearts racing, acquisition talk.
That's the big one, yeah. There are these unconfirmed reports, whispers really, about interest from a big tech player. Could be a large cloud provider, maybe a major chip maker, someone looking to just buy stock outright to instantly boost their own AI platform capabilities.
Purely speculation at this point, though.
Oh, absolutely. Purely speculative. But you know how those rumors can generate buzz and trading volume?
Okay, so just to recap, we've got almost unbelievable growth projections, a path to profitability based on that operating leverage concept, strong technical charts, and a whole bunch of potential catalysts coming up soon, both real and rumored.
Pretty much sums it up.
It sounds almost, well, perfect, which means we absolutely have to talk about the risks. What are the critical downsides, the caveats that every single investor needs to understand here?
Yes. This is where we really need to put on our critical thinking hats. First off, let's just circle back to that profitability timing risk.
It's not guaranteed.
Not at all. The company is still, technically, operating at a GAAP net loss.
Right.
Making actual profit isn't a sure thing. It depends entirely on them continuing to scale at this exponential rate and expanding their margins flawlessly.
So if execution falters,
or if, say, the pace of AI spending just temporarily cools off for a bit, that 2027 profitability target, it could get pushed out quite a bit. That's a real risk.
then competition must be fierce in this space.
It is absolutely brutal. You've got the giant hyperscale cloud providers constantly trying to encroach, plus other specialized players popping up. It's a permanent risk. Stock has to execute perfectly operationally and constantly stay ahead on the tech curve, deploying the latest specialized hardware. They just can't afford to fall behind.
Okay, those are significant risks, but you mentioned there was one caveat that's maybe the most crucial one for people to grasp right now.
Yes, absolutely. And this is the point we really, really want you, the listener, to understand clearly. It's what we're calling the disclosure gap.
A disclosure gap. What do you know?
So fundamentally, almost our entire analysis today, all those specific revenue numbers, the EPS targets, the path to profit, the margin details, it relies very heavily on analyst consensus models and data from financial aggregators.
Okay, and why is relying on that a risk in itself?
Because, and this is the crucial part, as of today, November 10th, 2025, we haven't been able to locate any official 10K annual reports or 10Q quarterly reports filed with the SEC for stock.
Wait, really? No official SEC filings?
None that we could find readily available through standard databases. And those filings, the 10Ks and 10Qs, those are the official certified documents that give you the verifiable financial health of a public company.
So without those, what critical financial details are we and the market kind of just guessing at or taking analyst word for?
Well, we can't independently confirm the precise health of their balance sheet. Things like their exact liquidity position, their debt levels and debt ratios, verifiable free cash flow numbers. Now, the super high growth implies they have access to capital, right? But without those official filings, the financial fundamentals we've been talking about are based on projections and models, not on independently audited, verified financial statements.
That adds a pretty serious layer of uncertainty then. Information risk.
It adds a very serious layer of information risk for you, the investor, even with this really compelling bullish story.
Okay, that context is absolutely vital. It sort of shifts the investment case, doesn't it? It's not just about the fundamentals. It's also heavily dependent on trusting the street analysts and the company's ability to deliver, kind of without that public financial scrutiny you usually get.
That's a perfect way to put it. So given everything, the incredible growth story, the strong sector tailwinds, the analyst conviction, but offsetting that with the real profitability timing risk and this, frankly, quite serious filing gap.
Where does that leave the overall view?
Well, the overall consensus rating still remains highly bullish, like a 9 out of 10. It seems the market believes the growth story outweighs the risks for now.
So it appeals to different types of investors.
Yeah, it seems to appeal both to, short-term traders looking to play potential spikes around earnings calls like today's, and to long-term investors who really want to bet on that huge secular growth trend in AI infrastructure over years.
Near-term volatility seems almost guaranteed, though.
Expected, yeah. But the underlying thesis, the core story, it remains structurally very compelling, despite the caveats.
So final thought for people listening then, given that extreme reliance on projected growth and analyst ratings, and especially this current absence of verifiable public filings,
Yeah.
how do you weigh the near-term catalyst, like today's Q3 earnings report, which gives us an update on those non-verified numbers against the huge, overwhelming confidence everyone seems to have in the long-term secular trend that's driving AI infrastructure demand? That's the real balancing act, isn't it?